So in today's economic update, Alex Brandreth, our usual presenter, the Chief Investment Officer at Luna Investment Management, will look at, are we heading into another financial crisis? Obviously, there's been issues with the banks that you've seen in the press over the last 3 or 4 months. Looking at the high levels of inflation and the impacts that this has on interest rates, and also what you can get as cash in the bank. A review of the economic growth and the impact this is having on individual portfolios. So just before I pass you over to Alex, some general housekeeping. Can we make sure that everyone's on mute so there's no background noise? The presentation has been recorded and we can get this out to anyone should they wish it. It should last, the webinar should last around about 40 minutes, and at the end there will be the usual questions and answers. So without further ado, I'd like to pass you over to Alex Brandreth, Chief Investment Officer at Luna.
Thanks, Stuart, and thank you everyone for dialing in today, and to Pareto for asking me to present again. It feels like every time we're doing these quarterly updates, it's quite busy, and it's certainly been another interesting quarter, as kind of Stuart touched on, mainly within the banking sector, really. The banking sector created a lot of volatility in March and concerns, and we've had a lot of questions from clients, and we've done quite a lot of work on it anyway. So we'll share our thoughts on that, as Stuart said. So I'm just going to share my screen and we can dive in. There we go. So Stuart's already given the overview of what we're going to be going through today. Are we heading into another financial crisis, given all the concerns on US and European banks that we've had over the last month or so? We've had inflation out today. It's a lot stickier than was expected, so we'll touch on that. And the reason the Bank of England have been increasing interest rates so quickly over the last year or so is because this high levels of inflation. So we'll touch on that. We've actually been going through, quite surprisingly, if you read the headlines, you wouldn't necessarily think it, a very strong period of, or better than expected, maybe not a strong period, a better than expected period of economic growth. It was widely expected that the UK was probably in recession, but the economic growth figures that were released for the last quarter of last year, so October, November, December, actually showed some modest growth. So we're technically not in a recession at the moment. And it's not just last year, it's also forward-looking. Economic growth has been revised higher this year by a number of different bodies. And, you know, as always, we're investors. We spend a lot of our time thinking about all of these impacts, but most importantly, how they impact individual companies, how they impact in different asset classes. So we'll give you an overview of the impact this is having on markets. There is a Q&A box. We'll be answering questions at the end, but if you do have anything when we're going through, please feel free to type any questions in and we'll cover them at the end. So, as we touched on earlier, the main developments during March was the impact of the banking, US regional banks and Credit Suisse in Switzerland. So it really kicked off with Silicon Valley Bank, which is a specialist cryptocurrency technology venture capitalist bank. They came under a lot of problems in terms of just losing depositors. I suppose a bank is like any business at the end of the day. You're reliant on customers, and for a bank, that's depositors. And if you get a concern and you lose your customers or lose your depositors, it creates stress. That had a knock-on impact onto Signature Bank. It was almost looking for the next bank that could be at risk. So you saw depositors withdraw from there. And then kind of that then came across to Europe and Credit Suisse. And Credit Suisse has been stressed for a number of years, and I'll touch on why in a second. So I think the most important thing to go through is, well, why has this happened? So the first point of to mention is, look, we've been going through in the UK, US and Europe a period of increasing interest rates. And that has made, as has a number of consequences. You've seen investors been borrowing money and taking on debt. And people do that when money is free. And with interest rates being at 0% over the last decade or so, everyone has been able to take advantage of very cheap money. And that's mean that there's been speculative areas and bubbles that have popped up. Probably one of the best I can think of at the moment is maybe kind of cryptocurrencies, which have come under a lot of stress. And that's important because, as I mentioned, Silicon Valley Bank had a lot of those type of clients and those depositors. And they were feeling very wealthy 2 years or so ago when cryptocurrencies were doing very well. But over the last year or so, we're feeling less wealthy because of the impact of falling prices has had. On top of that, they are more venture capitalists and technology orientated businesses. And that requires a lot of capital to be invested and deposits to be drawn down on a regular basis as well. So there is always a natural drain on the deposits on these banks. So that's exactly what happened. We've been in an environment where interest rates have been low and moved high. People have been taking extra risk, and these banks have been losing depositors. And I suppose the other point as well is, cash deposits now are also a lot more competitive. You can move banks very quickly. If one bank isn't giving you a good interest rate, you'll move and you'll go to a different bank, and it can happen very quickly compared to maybe 20 or so years ago. When banks lose depositors, they have to obviously fulfill their requirement to give their money back. And what banks do is they give access to savers to have access to their cash straight away. But what they're secretly doing, or not secretly, what they do behind the scenes is they go away and they invest that to get a higher return. And what the banks have been doing in the US and globally is been buying bonds, because they're seen as traditional safe haven assets. But with the increase in interest rates and fall in bond prices, when they've been selling these bonds back into the market, they've been generating a loss. So they've been losing depositors, they've been forced to sell assets, they've generated a loss, and that's put their balance sheet under some stress. And Silicon Valley Bank tried to do an equity raise to try and shore up the balance sheet, but that failed. And that was one of the main reasons why they came into the problem. On top of that, as we know, crises can build very quickly. We're in a social media world now, and people can start to spread information very quickly. And that means that banks can be more vulnerable, and you can see things escalate a lot quicker than maybe you would have 10, 15 years ago. And as I've said, with regards to deposits, you can see individuals moving a lot quicker with regards to moving deposits because technology's improved so much. It's also come to light that there has been a lot of regulation over the last 15 years since the financial crisis. And that's put in place to avoid instances like this. But in the US, it seems that the regulation was only across the top 15 to 20 banks, and regional banks had less tight regulation. And that's really been impacted, and they haven't been monitored as closely as they should have been. There's a lot of stories coming out at the moment about the SEC in the US being made aware of the problems with the US banks months ago. This is just speculation, so I'm not sure if there's any truth to it, but there certainly should have been more regulation, and perhaps that's something we'll see in the coming months. And as I touched on, SVB had a very specific depositor base, which has been under stress, and another reason why they were losing deposits. Credit Suisse, I mean, they've almost lurched from scandal to scandal for a number of years. They came under pressure last year as well. We did actually have some Credit Suisse structured product exposure within client portfolios at Luna, and we decided to sell them last October because we were getting concerned about Credit Suisse as a counterparty bank as well. So Credit Suisse isn't new news, but like anything, as I said, whenever risk starts to build, investors start to challenge the market and they look for the who's next. And Credit Suisse, because it has been so weak and mismanaged for such a long period, was always the natural casualty there. What has been very impressive has been the response by governments, by central banks, because as I said, we've all got very recent memories of the last financial crisis and the impact that had on the economy, the impact that had on individuals. And you need a strong banking system in the economy to be able to operate. And without one, it has serious economic impacts. So what's been very impressive was how quickly this has all been sorted by the different governments, both in the US and in Europe, and central banks to be able to stop this contagion of potential another banking crisis. So what have they done? First thing that US regulators did was confirm that all depositors can get their money back. Sounds quite a simple thing, but people are taking their money out because they're concerned that the bank's going to fail. If you say that everyone's going to get their money back, then it puts everyone at ease. Obviously, within the UK, we've got the 85,000 support mechanism. One other thing that we could see coming in the coming years is maybe that being increased, because that was done a number of years ago and it's not been keeping up with inflation. The US also gave banks access to emergency funds. This again was really important because that meant that instead of banks having to sell bonds, generate a loss, and have their balance sheet stressed, it meant they could go to the US Federal Reserve, borrow money to be able to support depositors. And it just meant that the banks were a lot more secure and less at risk. In the UK, Silicon Valley Bank UK branch was bought by HSBC for the expensive sum of £1. Again, that was done very quickly. Silicon Valley Bank UK was actually very profitable, so it looks like it's quite a good deal for HSBC there. And then UBS and the Swiss authorities pushed through a purchase of Credit Suisse. So the two Swiss banks merging there, and that was again done over a weekend, but the week before would have been causing a lot of stress. So you have seen a lot done over a very short period of time, and who knows if there's going to be other banks that come under pressure, but the headlines have certainly stopped and bank share prices have recovered significantly over the last few weeks. And that in part is thanks to the response from regulators and central banks. But by all means, I don't think that's over. As I said, there's further regulation that needs to be done, particularly within these US regional banks to stop these risks building again. As I said, it's crucial that we have an operating financial system, and banks are key to that. So the question that we asked right at the beginning is this 2008? Are we going through another financial crisis? And I don't want to scare everyone with ratios and jargon, but I think this is really important to understand when thinking about banks. And it's called a core tier 1 capital ratio. And we put the definition from Investopedia on the right hand side there. Basically it's a measure of the bank's financial strength. So it looks how strong a bank is. And on the left hand side, you've got the chart of what core tier 1 ratios are in the US and Europe. So Europe is that purple line and the grey line is the US. This chart goes all the way back to 2009, so bang in the middle of the financial crisis. And it just shows that both lines have moved from bottom left to top right. So banks have become stronger. Their financial strength has improved dramatically over the last 15 years. You can see that core tier 1 ratios in Europe were around 9% in 2009, whereas now they're closer to 16%. In the US, they've gone from 10% to just around 14%. So banks have increased and their funding, they've supported their balance sheets, they've taken less risk. Banks are a lot stronger than they were 15 years ago. And that's why you aren't seeing headlines of UK banks coming under pressure. There's not been a mention of a UK bank over the last month or so having any pressure. You haven't seen anyone queuing outside to get capital back. So we just wanted to provide some reassurance that this isn't 2008. Banks are a lot stronger than they were back then. And this is principally because regulation has come through to make sure that banks are a lot stronger. But in the US, that can certainly go a little bit further and extend from not just the big banks like JP Morgan, etc., and Morgan Stanley, but move to these regional banks to make sure that they have the same regulation and is strong to avoid these problems in the future as well. So that's all I wanted to mention on banks, really. I can cover through the main points of why this happened, the response from regulation, and the fact that we don't think we're going into another financial crisis anytime soon. Now, some good news, and this is principally on the left, really, and on the right. Economic growth has really surprised on the upside in recent months. I mentioned earlier that the UK has avoided a technical recession, which is 2 quarters of negative growth. We showed this chart at the last quarterly presentation, and the UK GDP for 2023, which is this purple bar here, was actually down at -1%. And you can see that economic growth within the UK and expectation has been revised up quite significantly. And it's expected that the recession, if we're going to have one, if it's going to be very mild, if we do have one, or the economic slowdown is going to be very mild. I suppose the other key point to mention is 2022 was actually a very strong year. The UK grew quicker than most global nations. It grew quicker than Europe, US, Japan, and China. And again, you really wouldn't have thought that was the case when you read the headlines. Obviously, that's been in the past. Other global nations are expected to grow strongly this year. The IMF has said that they expect global growth globally this year in 2023 to be around 3%. So we're not having a global recession. And that's important because what goes on in the UK is impacted just as much by the UK economy, but what happens in global economies as well, like the US and China. The other major development at the end of last year was China's reopening and their stopping of their zero COVID strategy. That was a major impact on markets, and you saw equity markets bounce very strongly from October, November, December on the back of China reopening and the fact maybe that markets were just oversold at the time. And you can see the impact that it's expected to have in China this year. So we've seen this several times as the UK has gone through various lockdowns and reopenings. When you have a lockdown, it reduces your economic growth, but it's almost like a coiled spring. When the economy reopens, everyone rushes back to do the fun things, go on holiday, go to the pub with their mates, go to restaurants, etc. And economic growth expands very quickly. And that's exactly what's happening in China. Chinese economic growth actually came out this week and was a lot stronger than people had expected it to be. And that's all because of this reopening effect. And China really matters. China is the second biggest nation in the world, and economic growth driven by China will have a big impact on the UK. Now, on the right-hand side of this chart, we're showing purchasing managers indices, PMIs. It goes all the way back to 2010, and it shows the US, Europe, and UK in these different lines. This 50 line is important. Anything above 50 is signaling that the economy is expanding. Anything below 50 is showing that the economy is slowing down. And the reason we show these PMIs is history has shown that these are the most accurate way of getting an up-to-date information on what the economy is doing right now. And why do I say that? I mean, I've just been talking about the headline official figures on GDP, but the information at the moment is still to the end of last year. So we're kind of 4 months into this year and we're still talking about GDP figures, official GDP figures, which are released for the previous quarter. Whereas PMIs really give an indication of what's going on with the economy right now. So that they're a better leading indicator of what's going on. And you can see that we have had periods of contraction. You have the European financial crisis when concerns over Greece, Italy, and Spain came through and the debt that they had, and that really impacted Europe. And it did bring down the UK and US at the same time. You can see the impact of COVID, where economic growth just fell off an absolute cliff. And then you can see the impact of further lockdowns here. And there was a contraction at the end of last year, but very encouragingly, these lines have now all moved above 50. When we did the last presentation, they were below 50. So it shows that all three major economies, UK, US, and Europe, are now in expansion territory, which kind of supports the data we mentioned earlier that economic growth this year has been revised higher. NICE have also forecast, let's get the numbers for you, that the UK economy is going to grow by 0.2% in 2023. So they're slightly more optimistic than the Bloomberg survey that we've included here. And they've also said that they expect economic growth next year in 2024 to be 1%. So economic growth is certainly improving a lot stronger than had been expected, which has been a positive to the markets. Now, the joys of putting these slides together is that they go out of date very, very quickly. And we've had CPI, consumer price inflation, released today. And as Stuart mentioned, it came in at 10.1. It was expected to come in slightly lower than that. It was expected to come in at 9.8. The previous reading was 10.4. So we have fallen, and you can see over the last few months, inflation has started to fall back. But it is remaining a lot sticky than everyone expected. Importantly, this inflation reading today is for March, so again is a bit lagged. And I've read the data that was released by the Office of National Statistics this morning, because I'm a bit sad like that. And the main reason why inflation's high as well is because electricity, gas prices are still high, so that is still having an impact on inflation within the UK. I'm sure we all realise that when we look at our bills on a regular basis. And the other impact has been service inflation. So it's now more expensive to drink alcoholic beverages. It's now more expensive to go to the shops. There seems to be a lot of supermarket inflation coming through at the moment because of higher food prices. So that's certainly having an impact on the inflation figures. That being said, you are starting to see the commodity figures starting to come off. So if you go back a year ago, this was almost at the peak of oil prices, because this was, when Russia invaded the Ukraine. So the oil price was higher a year or so ago. And as we move through this year, that's going to start to have a less and less impact. So it is expected that inflation is going to continue to fall. But it is a lot sticky and staying higher than the Bank of England would want, and perhaps individuals would want as well. As I said, this is this is a forecast of where inflation is going over the course of this year. You've got the UK in that blue line, you've got US in grey, and you've got Europe in purple. And the UK has been stubbornly high. It's been stubbornly high compared to other nations. You can see that with the blue line being above the purple and grey. And the UK is not seeing inflation fall as quickly as you are in other countries. The US actually peaked 6 months or so ago, and US inflation is now down to 6% at the 5% at the moment. European inflation is down to 7%. So the UK with a figure of over 10 is really starting to stand out versus other countries. And one of the reasons why the UK is seeing structurally higher inflation is just a function of how weak the pound has been. When we're buying commodities in the UK, we're doing so in dollars mainly, and with sterling being weak, that adds another level of inflation within the UK, as well as kind of the energy price caps that other countries don't have. They have a quicker mechanism for energy prices to come down than we do in the UK. The US is energy independent, and they're not reliant on natural gas from European nations, etc. So the US is in a structurally better situation from an energy market perspective. I suppose the other point that I didn't mention on inflation, and we got wage inflation figures through this week, and they came through at around 6%. So that is again having another impact on inflation within the UK, because if everyone's getting more money, then supermarkets, restaurants feel that they can put their prices up slightly higher because everyone's feeling slightly wealthier. And there's certainly been an impact of that coming through. The other important point to mention on that, though, is if you've got inflation at 10% and you've got wages going up 6%, that's still a 4% gap. And that means that we're all feeling slightly poorer on average because of this high level of inflation. So that's where we are now. But as I said, inflation is expected to come down. And within the UK, you can see that by the end of the year, it's forecast that we could be at 3%. That could be a little bit higher at the moment, though, just because of how sticky inflation's been. So this has given central banks a real headache, and the numbers today will be giving the Bank of England a headache as well, because the Bank of England have got a dual mandate. On one side, they need to support the economy and keep economic growth and activity up, but they also need to keep price stability, and they don't want inflation to be embedded in psyches. They don't want people getting pay rises of 5 or 6% every single year, because that's going to lead to more sticky inflation in the future. That's the inflation that they're really worried about. I don't think the Bank of England are really worried about commodity price inflation. They're really worried about this being ingrained in the system. And that's why you've seen a series of interest rate hikes. So interest rates in the UK are now at 4.25%. You can see that's the highest level going back to 2007, before the last financial crisis. And back to the point you made earlier, we've been in this era of cheap money where people have been willing to take on extra debt, leverage up to a certain extent because it's been easy to do so. And it's with interest rates higher, that's had a significant impact on people's ability to be able to do that. It's slightly less attractive to get debt nowadays. That being said, we are in a very leveraged economy. We have a lot of debt. We have a lot of debt at household level. We have a lot of debt at government level. And that means that if interest rates keep going up, the cost to service that debt is just going to keep going up. And there's a point at which there's a breaking point in terms of you put interest rates up too fast and too much, that the cost to service that debt is just going to cripple the economy. And in my view, we're very close to that point. And you are starting to see central bankers now starting to suggest, oh, maybe we're getting towards the end of this interest rate hiking cycle. You've seen in the UK 0.25% increases as opposed to the 0.5% increases in the previous months. So it does get the sense that central banks are starting to slow down on increasing interest rates. In the US as well, the problems with the US regional banks has meant that you'll see tighter lending standards from US banks. And that almost in its way acts as a way of slowing down the economy as well. And the Federal Reserve have actually already said that they expect that interest rates may now peak because of the developments within US banks. So central banks are in a very tricky situation. They've got inflation, which is still very high, but they've got economies which are slowing, and they're trying to almost generate this soft landing, which looks very difficult to be able to do at the moment. And the other important point with this is that interest rates going up is lagged. You don't feel the impact of interest rates going up straight away. So we really now are starting to feel the impact and see the impact of what increasing interest rates is doing. And that's why you're seeing banks coming under pressure, etc. now. So you might start to see other companies where they've taken on too much debt starting to come under some pressures over the coming months as well. Just on some words of reassurance on that though, at Luna, we're very conscious about the type of companies that we invest in, and levels of debt is something that we've been focusing on and making sure that our companies that we are investing in haven't taken too much debt. We had unemployment out this week as well. So the unemployment rate popped up to 3.8% from 3.7%, but it's still very low. And that's one of the reasons why you're still seeing quite a lot of wage inflation. Unemployment's a lagging indicator. You can see here that it actually peaked in 2009, 2010, and this is when the economy was recovering from the financial crisis. So wouldn't be surprised to see unemployment rate continue to move up, because economic growth is going to be slightly more challenging. We're not going to be in a strong environment. You're starting to see companies take on less people, and there will be companies that come under pressure over the coming months and years. So we are expecting unemployment rate to pick up slightly, but that shouldn't be anything to be concerned about. So that's really what's going on with the economy. As I mentioned, the banking system has been the key development in March, but the same topics of inflation and interest rates are still there. They're still having an impact, and they're still dominating central bankers and markets. And here, we just wanted to highlight how weak investor sentiment has been. And that matters because if investor sentiment is weak, it means you have a lot of sellers. And over the last year or so, markets have been weak because you've seen more sellers than buyers. On the left-hand side, you've got this bull and bear indicator, which is done by Bank of America. What's amazing is how low that got in October 2022. It actually got down to 0, which is everyone is very bearish, which tends to be a very positive signal. When everyone is already sold and they're already over worried, then that tends to be the best time to buy in markets. And things have improved since in October. Markets have bounced back very strongly. I mentioned China reopening, but equity markets were very much oversold at the end of last year, and they have bounced back on that. It was expected that we were going to go in recession. Economic growth is surprised on the upside, and now investors are more willing to take risk. But you can see there that sentiment is still very weak. On the right-hand side, you've got a chart. This is done by the American Association of Individual Investors, AAII. And what it just shows is how bullish or bearish is. If the line is positive and above that 0, then it means that you've got more people that are willing to buy stock markets and investments. If it's below 0, you've got more people that are nervous about the market. Now, this chart goes all the way back to 1991, and it shows that individual investors in the US have never been this negative about the equity market, which is astonishing. And again, that just means that investors are already nervous, they're already sold, they've gone to cash, and there's an opportunity when markets recover. Now, just taking a step back and just looking at markets over the last year. So you've got the major stock markets. This is all in sterling terms on here. You've got the US, the S&P 500, Nikkei in that kind of maroon color, the FTSE 100, our own stock market, in yellow, European stock markets in green, the Nasdaq, which is technology, and the Facebook, Amazon, Apple, etc., dominate that market in that light blue, and the Hang Seng. Now, I suppose over the last year now, most markets have delivered slight positive returns. You've got the UK and Europe, which have been the better performing markets. Europe up 8% over the last year. What's been the laggard has been the technology companies, and that's the Nasdaq performance there, which is down just around 5% over this time period. Importantly, though, what you've seen is a bit of a reversal over the last quarter. Technology companies have bounced back very strongly, and that's a function of the fact that they have been under pressure throughout the course of 2022, but also the fact that interest rates not going up, actually acts as a support for technology companies. And maybe if interest rates don't need to keep going up, then it's been seen as a positive, and that's why more growth and technology companies have done very well. It's been a hell of a ride if you've been invested in China over the last year. You can see it was performing very strongly. Lockdown came through, it was very weak. The economy reopened, and the market performed very strongly. But then you've seen a bit of profit taken, and China's come off quite significantly. I suppose the purpose of showing this chart as well is different markets perform at different times. And that's why it's important when we're building portfolios that we're not just exposed to what's going on with technology shares, because that would have clearly been to the detriment of performance over last year. And if you go back to before, just as COVID was coming through, everyone was saying that you should only own technology companies in the US because the UK was a terrible place to invest. You fast forward a year, and now Europe and UK is a better place to invest and has performed a lot stronger. The main headlines over the last year, though, because of the dramatic increase in interest rates, has been what happened in the bond market. And if you go back to what I said about why Silicon Valley Bank came under pressure, it was because they were selling bonds and they were realizing a loss. And this blue line really highlights that point. So if you go back to the end of March to the end of March this year, you can see that government bonds have lost just 17%. Government bonds, gilt-backed safe haven assets, are not supposed to lose you 17% in a year. But what those US banks have been having to do is they haven't been buying gilts, but they've been buying the US equivalent bonds and mortgage bonds. When they've been selling those bonds, they've been realizing a loss. And you can see here that it's not just government bonds that have made losses over last year, corporate bonds, so buying bonds off Tesco's and Morrison's and BP and Shell have lost you 12% over last year. Strategic bonds, which are a bit more flexible, and emerging market bonds have lost you less money, but have still lost you a little bit over the last year. So it has been a very challenging environment for the bond market. That being said, over the last quarter, you can see, or the last month or so, things have started to improve. And again, this is the importance of diversification. Government bonds are seen as safe havens. And when you have stresses in the banking system, like we've seen in March, investors have been willing to buy government bonds again, and they performed a lot better. As well as that, when we started Luna, government bonds were delivering a return of 0.5% for 10 years. Now that return is closer to 3.5%. So you've had the starting place for buying government bonds today is a lot better than what it was when we started Luna 3 years or so ago. Now, we get a lot of questions about why the FTSE 100 has performed so well. It's close to 8,000. And portfolios are maybe not at those all-time highs. And there's a few reasons for that. One is that we don't just invest in the UK, and we don't just invest in equity markets. We've been very underweight bonds, but we have had some exposure. And as you can see, bonds have fallen quite significantly over the last year. But it's also not just we don't just invest in the FTSE 100, we invest across the UK equity market, we invest in smaller companies as well. And you can see, because of the fears of an economic slowdown, smaller companies have fallen quite significantly. The FTSE AIM index, which is the smallest companies in the UK, is down 20% over the last year. And whereas the FTSE 100 has really been supported by those higher commodity prices. So it's been supported by BP and Shell, which have performed very strongly on the back of a higher oil price. So just important point, investments in Luna portfolios are not just invested in the UK, they're invested globally in the US, Europe and Japan. They're invested across the UK stock market, so they're not just in the top 100 companies, they're invested across the board. And we also invest in bonds to provide that diversification within the portfolio as well. That being said, we do actually quite like the UK. We do like the UK stock market. You've seen a lot of bids over the last few weeks. The Hub Group got bid for this week. John Wood Group's been bid for. There's been a number of other bids that are coming through, and you're seeing that happen because UK valuations, UK companies are very cheap. So I'm going to start on this right-hand side, and this shows price to earnings ratios. It's just a measure of how cheap or expensive a company has been. The grey bar shows the average since 1990. The blue dot shows where we are currently, and then the green line shows the average since 1990. So it's a pretty long dated chart. So the first thing to say is most markets, apart from the US, are below average. So that means the starting point for valuations is pretty good. The blue line, this blue dot here for the UK is the cheapest global stock market which on this chart. So versus China, emerging markets, versus Europe, versus the US and globally as well. So the UK is the cheapest global stock market, and that's principally why we like it. FTSE 250 and smaller companies, because of their falls over the last year, are also very cheap as well. So it's not just the top 100 companies. The UK market is cheap as a whole. And then on the right-hand side, on the left-hand side, you've got what the expectations are for earnings. So a company's growing or shrinking. And you can see, well, the UK is expected to shrink this year, but next year is expected to be very strong, as are all global markets. And as I said, when we invest in the UK, we don't just think about UK companies aren't just exposed to what's going on with the UK company. Shell does not have any assets in the UK. I think they've got their head office in the UK. All their fields are elsewhere. It was called Royal Dutch Shell because it was a Dutch company for a very long period of time. But it's not a proxy of what's going on with the UK economy. So valuations are very attractive on the UK. We also, and to the point as well, China was down here over the last quarter. It has moved up slightly because of the bounce we've seen in Chinese markets in a very short period of time, but more recently they have come under pressure. But you can see there that emerging markets in China look quite cheap, and they've been falling in equity market prices for about 2 years. So there's another opportunity there, and with this, another area that we're pretty keen on. Now, we always like to add kind of a long-term chart, because as Stuart said right at the beginning, when we're investing, we're not doing so over a quarter. No, we spent today talking about what's happened over the quarter, but we're really thinking what's happened over the next few years. We're thinking about what's going to happen over the longer term. We're picking companies that we think can deliver good long-term performance, fund managers that can deliver good long-term performance as well. So the purpose of showing this is to concentrate on the long term, and there's a few points that I really want to bring out on this chart. So let's start with the left-hand chart. This just shows the power of compounding, which I think is the 8th wonder of the world, by the way. So if you invested £5,000 and you got 5% growth per year, and you started at the age of 25, that at the age of 65, that would have grown all the way up to 639,000. But if you delayed making that saving by 10 years and you started saving at the age of 35, the exact same amount, you can see you're just under half the amount. You're at 354,000. So it's a massive impact how investing for a very long period of time and continue to invest can have on your overall wealth. On the right-hand side, this just looks at the returns of the FTSE All Share, and it looks at reinvesting dividends. So that's important because dividends are quite high in the UK. You've got around a 4% dividend yield. So every year, without asking, all being well, and companies can pay dividends, you're going to get about a 4% return purely from dividends. So what happens if you reinvest that over a period of time? And you can see here it goes all the way back to 1986. So if you'd reinvested all those dividends, and you started with £5,000, you would now have just short of £120,000. So that's not that's not putting more money in every year. That's purely on that first initial amount and reinvesting dividends. However, if you've taken those dividends out and you use that income to pay for your lifestyle, whatever you may want to do with it, or a salary, you can see that if you'd not reinvested, that you'd still make a positive return. You'd still turn £5,000 to £30,000. But the power of impacting dividends is had a significant impact. There's a almost £90,000 difference just from reinvesting dividends, and that's something that's really important when thinking about investing. So just wanted to really highlight that today. And then the final point, back to what Stuart said as well, is the longer term. You can see here there has been periods when the market has delivered negative returns. You've got the financial crisis here, you've got the tech bubble here, you've got COVID, you've got the falls that we saw last year. And when those falls now, they look very small. The financial crisis, that was a 50% fall in the stock market. But when you look at that chart now, it looks very small. And that's because you're taking a longer term period. You're zooming out and looking at things over the longer term. And when we look back at COVID in 5 years' time, and we really zoom out, it felt like a really big impact on the market. It was. The stock market fell by 25% in 2 months. But again, when we zoom out and start to take a long-term impact, you put the impact of compounding on, you put reinvestments in, then it can have a significant impact on investment. Stuart was just talking to me about a client before we came on that was potentially looking to disinvest and go to cash because you're getting higher rates on cash at the moment. But you'd be doing so after the market's been weak, and you'd be locking in a return of 4%, whereas equity markets over this time period, you're getting a 4% dividend yield and you are getting capital growth. So the equity market over this time period has returned 8% over the long term. So if you're willing to take a very long-term approach to investing, you can still deliver superior results from investing in equity markets as opposed to being in cash. But you have to be willing to take the short-term volatility that we've been going through over the last few months. So just to summarize, the good news, hopefully, we don't think we are heading into another financial crisis. There may be other banks that are stressed, there may be. We'll find out over the coming months. But the UK banking system is very strong. Regulation, Basel III requirements have meant that those core tier 1 ratios I mentioned, the signal of how strong a bank is, have improved dramatically over the last 15 years. Governments and central banks will do everything they can to avoid another fail in the banking system, because they realise after the last financial crisis that the banking system is incredibly important. And that's why they've been acting so quickly to support and make sure that banks are sorted, whether that be supporting purchases to go through very quickly, providing new support to banks to be able to lend, or just supporting depositors so you don't get those concerns about having to withdraw your assets. Inflation is stubbornly high. You can't ignore that in the UK. Globally, inflation is falling a lot quicker. And we do think that inflation is going to continue to fall as we move through the course of this year. Interest rates are close to peaking. You've probably seen peak rates in the US. That matters because the US Federal Reserve is the main central bank, so that has a big impact on asset prices. The UK is very close to peaking. Markets have performed well. Since the end of September, when I mentioned market sentiment was on the floor, equity markets have performed very strongly. So you've seen a strong end to last year. January, February was a strong start to this year. March was a little bit weaker because of the impact of the banking system. But again, in April, markets have bounced back. And that's because I think the economic growth is improving to the upside. Investor sentiment is just too bearish. And that's mean valuations are very cheap, which is the last point there. So that's all from me. I'm going to stop sharing now. Stuart, I've noticed we have had a couple of questions come through. If you want to run through them, and I'll answer them after some water.
Great, thank you, Alex. As always, very informative. As you say, we do have there's 3 questions that have come through, but if anyone has any further questions, please feel free to add them in. So the first one, you've mentioned quite a bit in inflation, and both you and I before the seminar were talking, we were hoping it would be in single digits. And I know the Office for National Statistics were talking about it coming down to around about 3% by the back end of the year. We think it'll be slightly higher than that. But if inflation does stay higher than expected, do you think portfolios will be able to keep up with this and provide real-term returns?
Yeah, it's a very good point. Over the last year, portfolios are down and inflation's been higher, so it's impacted on real as well as kind of nominal terms. I do think that in portfolios will be able to keep up with inflation and potentially beat inflation over the coming years. There's a few reasons for that. One is that kind of valuation backdrop that I mentioned. So it's not just the equity market, you're getting higher returns on bonds now. So we can buy corporate bonds now, which return 7 or 8%, which for a low risk investment is pretty attractive. And you know, inflation's above 10%, but if we get back to that number that we mentioned at kind of 3 or 4% by the end of the year, then a 7-8% return on a corporate bond is a positive real return. So you just have to look forward a little bit. As I mentioned, the long-term returns from equity markets is around 8%. So again, when inflation falls below to 3 or 4%, that's another positive impact. You could say that equity markets are cheaper, so you could make a case that 8% is maybe a low figure in terms of equity market returns over the coming years. I mean, when equity markets have been weak, they don't bounce by 8%; they tend to bounce by 15 or 20%. So it's definitely an argument that you could see an equity market bounce coming over the coming year or so.
Yeah. So it's important to stress there about making sure you're still in the markets when that bounce back occurs, because by missing out on even just a few days, that can have a significant impact upon overall returns, can't it?
Exactly, yeah. No, some of the, I remember showing that chart on previous presentations that some of the best, if you miss the top 10 days, that it can have a really big impact on your overall compounding impact, which is that kind of return chart that I showed before. I suppose the other point just on that question is it really depends on the level of risk that the portfolio is willing to take as well, because more cautious portfolios will deliver lower returns. That just goes without saying. Higher risk portfolios will deliver higher returns over the long term. So it really depends, as well as that, just the level of risk that individuals are willing to take and their time frame.
Okay, good, thank you. Another question with regards to some of the lower risk asset classes, and you mentioned bonds have had a difficult period. Do you think that will turn around over the next few years, or do you think there'll be a long protracted difficult period for such asset classes as gilts and bonds going forward?
Yeah, that's a great question now. So the reason government bonds were really weak last year is because of inflation and the central bank putting up interest rates so quickly. Gilts move in anticipation of what's going to happen with interest rates. So if we sit here today, what's the expectation for interest rates? Well, most people think that interest rates are nearly peaked. So that should take the pressure away from gilts selling off. You could make an argument, and it's starting to be priced in by the market, that interest rates start to fall at the end of this year and through next year. Because if we do have a recession, then interest rates will have historically been cut to try and support that. And if that happens, then gilt prices would go up. because it'd be the reverse of what happened last time. So I think the pressure within gilts is reduced significantly. It was very interesting in March to see how they performed in that risk-off period, that they did provide the diversification benefits that they didn't provide last year. So my view looking forward is that gilts now, because they've got a higher yield, because of the fact that interest rates look close to peak, look a better investment. And we have actually been increasing our exposure to bonds and gilts over the last few months to take advantage of these high returns that we're going to be getting, and also from the fact that you can just get good diversification from holding these securities, and that was proved right in March.
Okay, good, thank you. And the last question with regards to China, is China the new superpower relegating the US going forward? I know there was a lot of talk in the press about China brokering the deal between Iran and Saudi Arabia, potentially moving oil prices to the yen as opposed to being denominated in dollars. So how do you think that could affect the markets and clients' underlying investments going forward?
Yeah, I think it's happening. I mean, the US are trying to stop it. That's why they've done their Inflation Reduction Act and their CHIPS Act. So basically telling US manufacturers that they have to buy US components as opposed to Chinese components. They're really trying to support and kind of derail China to a certain extent. And that's almost why you've seen the trade war over the last few years and the ongoing kind of issue with Taiwan. The US is very keen to mention it on a regular basis with regard to China as well. So the US is very nervous about not being the main superpower and is doing everything in their power to try and stop that. So, but I think it's inevitable. You can't stop this strength in the economy that's going with China and how quickly they're growing. Well, how does that impact portfolios? Well, as I said, when we're buying, it's not necessarily where a company is listed or in the stock market that matters, it's where the earnings are produced from. So from a UK investor perspective, if you can find a company listed in the UK, which is benefiting from both US growth and Chinese growth, then that's what matters. And Chinese economy has been one of the fastest growing over the last 20 years, but the stock market has gone nowhere, literally nowhere. You've made no money from investing in China over 20 years. So it doesn't necessarily matter that you've got the fastest growing economy, because that hasn't been translated into stock market returns as well. And the reason for that is because some of the biggest companies in China are state-owned with poor governance. So it really comes back to the kind of the bread and butter investments of making sure that you're buying good quality companies that are getting structural growth drivers, but are managed very well. And if you don't have that, if you don't have all of those ingredients, then that's where you don't make money. And sorry, probably the other important aspect, which is why I always mention it, is valuation. You want to buy cheap companies at the same time. So you don't want to be overpaying for businesses to get those characteristics. Okay,
good. Thank you. I mean, Alex, what I'm getting from this is there's a lot of talk about risk, return and volatility. But for our clients out there, what I would stress is the key to all of this is to have a well-diversified portfolio. So no matter if you're low risk or if you're high risk, you should have some exposure to cash, fixed interest, property, and bonds in different geographical sectors. And that continuous rebalancing should maximise return and mitigate some of the volatility that's going on in the market. But volatility can be our best friend or worst enemy, depending upon how we react to it. And at the moment, we've had historical times in the past where the markets have taken a dip, but it's important to ride out that storm and make sure that your underlying investments are still looking forward to your long-term needs and objectives, and not to react just in these short-term market movements. So I'd stress again to all of our clients out there, make sure that you're regularly sitting with your advisors, reviewing your risk profile, reviewing your risk score and the volatility, and making sure your underlying investments still reflect what your long-term needs are. I was talking in the spring budget about capital gains tax coming down and dividends tax coming down, so it's worth reviewing the structures of all of your plans with your advisors to make sure that they're still reflective of what you're looking to achieve. So thank you all for your time today and for dialing in. And Alex, as always, thank you for presenting. The next quarterly investment seminar will be on the 30th of July, and we hope everyone can join us. If there's anything anyone would like to discuss, please feel free to speak to your advisor or call into Pareto and ask for myself. We hope everyone has a good spring going into the summer, and we look forward to speaking to everyone over the next few months. So thank you again, and look forward to speaking to you all soon.
Thank you, everyone. All the best. Thanks, Stuart.